Gold is approaching a major liquidity zone right now, and smart money is already positioning ahead of the next big expansion move. Welcome to this explainer. Look, today we're stepping away from all the retail noise. We're going to focus purely on price action, institutional deal flow, and the actual macroeconomic drivers moving the markets.
But before we break down the order flow and jump into the charts, just remember, you can apply these concepts directly. Open a trading account with our partnered broker, Tomo Trader. You'll find the link pinned right down in the comments below.
The smart money setup. Okay, let's get into it. What we're constructing today is a professional hedge fund style market breakdown for gold. We're bridging macroeconomic fundamentals with really precise technical execution. You see, this isn't about guessing. It's about tracking where that heavy liquidity is resting and aligning ourselves with the smart money concepts that drive true market expansion.
To begin, we have to establish our bias by synthesizing the macro environment. Take a close look at the fundamental pressure currently weighing on gold. Despite all the ongoing geopolitical tensions, including stalled US-Iran ceasefire talks that really haven't yielded a resolution, WTI crude is actually dropping below that $91 mark. And more importantly for gold, we've got some very hawkish rhetoric coming from the Federal Reserve. Governor Schmidt has clearly stated that inflation remains the biggest risk to the economy. Meanwhile, Governor Daly basically reiterated that bringing inflation back to target is their absolute #1 priority. This firm stance on elevated interest rates keeps the US dollar strong, which inherently pressures gold since it's a non-yielding asset.
And that fundamental pressure perfectly frames our looming session catalyst. Friday at 7:30 p.m. brings the US non-farm payrolls and unemployment rate data. Forecasts are looking for an 85,000 job increase, making this an extreme volatility event. This is a true red folder risk that institutional players are already prepping for. This data, it's going to act as the ultimate liquidity injector for the technical structures we're about to analyze. So, zooming out to the macro technical view on the daily time frame, we're observing a definitive long-term bearish swing. Notice how price completely failed to sustain the structural highs up near $5,556. And following that failure, we saw some really heavy downward displacement. The institutional draw on liquidity here is explicitly clear. The market is basically being magnetically drawn down toward those daily sell-side liquidity pools, resting quietly below the $4,270 discount arrays.
A market structure break to the downside has solidified a strict bearish order flow. So the crucial takeaway here is that this massive structural failure dictates our institutional positioning, keeping our high time frame bias heavily short. We aren't looking to fight this momentum at all. Instead, we're actively looking for premium areas to just join it. Stepping down to the H4 timeframe, the bearish narrative gets even more granular. Price has exhibited a truly textbook series of lower highs and lower lows. Look closely at how the market recently swept premium internal buy-side liquidity, beautifully mitigated a structural supply zone right at the bearish order block around $4,514, and is now aggressively expanding lower. This is just classic textbook institutional delivery. Now, tracking the fractal delivery onto the H1 chart, we can see the immediate aftermath of that H4 mitigation. The recent rally back into the $4,513 zone was explicitly rejected. What we are witnessing is a sharp structural failure and a very clear market structure shift to the downside, carving out these clean, lower high distribution phases. Smart money is clearly distributing their long positions and building up shorts. Finally, we drop down to the M15 execution timeframe to actually find our targets. Institutional order flow is unmistakably drawn to the clean equal lows, sitting down at $4,443. These relatively equal lows act as an immediate internal sell-side liquidity magnet. You see, retail traders view this as a support floor, but institutional algorithms see it as a massive pool of stop losses just waiting to be swept. Actually, it's estimated that over 70% of intraday Forex volume is driven by algorithms hunting these exact kinds of retail stop clusters.
M15 bearish fair value gap. Right above the current market price sits our key area of interest. It's an active 15-minute bearish fair value gap, or a sell-side imbalance buy-side inefficiency. This sharp, unfilled pricing inefficiency is extremely well-defined. It opens at $4,454.50 and extends down to $4,449.50. This specific zone is serving as our immediate premium array for a high-probability intraday mitigation.
And that brings us to the specific executable smart money trade setup. We're looking for a short position entered within that fair value gap, specifically somewhere between $4,451.50 and $4,454.50. Our stop loss will be placed securely above the structural invalidation high, right at $4,458.50. Now, for the absolute highest probability, we want to see a minor lower time frame confirmation trigger precisely during the London and New York session overlap. Professional trading is entirely about risk management, so our trade management protocol here dictates taking our first partial profits, TP1, right at $4,443 to capitalize on the sweep of those M15 equal lows. The second that liquidity is cleared, we mechanically shift our risk to break even. From there, we leave a runner targeted for the H4 internal demand target at $4,427. If executed perfectly, this setup nets an approximate 1 to 3.7 risk to reward ratio.
The invalidation level. As professional traders, we always have to know exactly where our bias is proven wrong. So should we see a deep pro-trend manipulation that results in a daily body close above $4,463, well, this entire immediate intraday bearish framework becomes fully invalidated. If that happens, we simply step aside, preserve our capital, and wait for the market to print a new institutional narrative. 0.5%. That is the number you need to remember. Adhering to strict professional prop firm standards, your maximum exposure must never exceed 0.5% of your total account equity on this specific execution. Capital preservation is the absolute hallmark of a professional trader. We don't gamble, we execute calculated probabilities.
And speaking of calculated probabilities, we have a hard risk rule for this session. Because of the extreme threat posed by the upcoming NFP data release, this position has to be manually closed or, at the very least, shifted to a completely risk-free status a minimum of 30 minutes prior to that 7:30 p.m. volatility injection. You never hold unhedged, open risk into a major macro data event like this, period. That wraps up our institutional breakdown for gold. To follow future setups and trade along with these parameters, you can open your trading account using the Tomo Trader link located right in the pinned comment below, and be sure to subscribe for more SMC market breakdowns. But before you step up to the charts for your next session, ask yourself, are you just reacting to the random noise of the retail market, or are you actually tracking the quiet, deliberate footprints of institutional liquidity? Stay disciplined out there and trade safe.